right.
All right. Welcome to Instagram Live. We're going to be talking today about people who are making investments, what to look for in the investment, what to look for in the sponsor and the investment company, and in general, when you're making an investment, putting a sizable amount of money into a real estate project, what to be looking for.
Exactly. And I think, timing is everything. We just did a short video, or I did, talking about, why would you invest today? And so if you're going to be investing today, as you said, whether you are just a limited partner, a silent partner basically, or if you're a sponsor looking at deals, we're still doing it. I think you should be, but obviously you just have to take into consideration what's going on in today's economy in the world today. And, if you are a limited partner, meaning, hey, there's somebody who's an operator who's buying deals and I'm going to write them a $50,000 check, a $100,000 check, right? Like if I'm a doctor, a lawyer,
Engineer.
I was an engineer, not anymore. Thanks. And due to you, right? How should I be looking at deals? And I think the first thing is understanding, what are my investment goals? And does this investment align with those goals?
Right. Investment goals could be revolving around certain neighborhoods you want to invest in. Could be a certain product type. Like some people invest in industrial, some people invest in multifamily, some people invest in hospitality. So based on what you believe in, the markets that you believe in, the product types that you believe in, and very importantly, the sponsors, the investment company, and not just the company as a brand, but the people who are going to be running the asset, running the show, managing the project, managing the investment. Do you believe in those people? And that's one of the topics we're going to be touching on.
Exactly. And I think the biggest thing in terms of, looking at the economics is, are you a cash flow investor or are you an appreciation investor? Are you somebody who's looking at, making 5, 7, 10% on my money, year over year? Or is it like, hey, I'll give you money, I'll park it for a while and watch it grow from 100,000 to 150 to 250 and increase that over time? So I think
hybrid.
Or a hybrid, yeah, exactly. And I think we're kind of seeing that hybrid today, just given where the market's at, is like you can get cash flow deals right now while still having appreciation, and we'll talk about, a deal that we're buying. So first is what are your goals as an investor, and does the deal align with that? And the second is if you're looking at this investment opportunity, what are the assumptions that the sponsor is baking into the deal, and are these realistic, or do they just not make sense? Right? Are they trying to rent an apartment that should rent for $2,000 and they're putting it at $5,000, or are they saying, hey, I'm going to sell this property at a 2 cap, even though the market's like a 5 cap. So looking at those nuances that they're baking in, and we talk a lot about, why would somebody be an LP is you don't have the time or the energy, but, spending 2-3 hours, if you're seriously going to write a check, it's like analyzing the deal in this way. You don't have to know everything, but being able to determine what's real and what's fantasy.
And doing a little bit of homework based on the homework that the investment company did. So the investment company is going to generally send out a prospectus, investment deck, and it's going to have some comps for rental comps, sales comps, similar properties that have sold, similar apartments. In the case that what we do, apartment building investing, it'll have some apartments that have rented nearby, and it's important to make sure that they match up with the subject property. Both on location, so how far away are these comps from the subject property, as well as the amenities. So if you're looking at a 1-bedroom apartment in Santa Monica in a building that has a pool and a gym and a rooftop and ocean views, you can't compare that 1-bedroom at, let's say, $4,500 a month to an apartment that's abutting the freeway, hasn't been renovated, has a view of the alleyway, doesn't have a gym, doesn't have a pool, doesn't have any amenities. So you have to make sure that the comps are apples to apples. And that's obviously one of the things that we're talking about in terms of doing your homework to make sure that the information that's being provided is accurate and relevant to the investment that you're making.
Exactly. And then the third is, what's the sponsor's track record, right? Have they have they bought deals in this area, in this sub-market or general market, and have they been able to perform to say, how they're going to perform? Whether it's a renovate and flip, if it's a refi cash flow deal, have they done this before in this market?
Yeah, so like for example, what we've been doing is investing in apartment buildings in Los Angeles, and we have a track record. We've been doing this for many years. What is it, like 60 projects, something around there right now? Who's counting? But we've been doing it for a long enough time that we can show a track record of projects that we've done within Los Angeles. Now, if Max and I were to go to invest in apartments in Memphis, right, we would need to either team up with an operator who's local there and try to work with them to get to understand the market, to build up a track record, because it's very difficult to attract equity investors without having a track record within the market, because equity investors are going to say, have you done this before? Yes, but not in this area. And they're going to say, well, how well could you possibly know the market if you've been there twice?
Exactly. Totally. And then there's, how much equity does that sponsor have in? For us, we always try to have 10 to 20%, and now that's growing a little bit more, but we always have skin in the game. We're always invested in these deals, because we believe in them, I think first and foremost. Like, we always, whenever we look at a deal personally, like to buy and raise capital for, we're always saying, what if we were buying it completely? Like, if you and I, if we put all our money from our bank account in this deal, how would we feel? Because then we're aligned with the investors. It's like, hey, we have as much equity as you have in the deal. We have as much, to lose and to gain. So we're just at risk. And I don't mean that in a bad way, but it's like, we're basically aligned with you as the investor.
You want to make sure that the investment company, the people that are running the project, have, like you said, skin in the game. They have a sizable investment. When we buy a property, we make an acquisition fee. So to roll that money in is great, but it doesn't cost anything. So you want to see above the acquisition fee, how much money is the sponsor putting in, and is that a significant amount of the equity? Is it 5% of the equity? Is it 25% of the equity? I think this upcoming project that we're buying, we're going to be like around 50% of the equity, something like that. So when you see that the sponsor is putting up around half of the cash, you got to think, well, there must be something to this deal.
Exactly. And then there's the trust in the sponsor. And I mean, I don't know if you're trustworthy, if I'm trustworthy, but we'll let the people decide.
I certainly don't trust you. Yeah.
That's for sure. We'll luckily have Kaya.
Kaya we trust.
Yeah.
Kaya we trust.
But is this somebody? Because ultimately, you can sit there and analyze the deal and do your homework, but you're going to cut the check, and then the deal's going to be operating for 12 months, 36 months, 5 years, 10 years, and you're going to be out of the picture. Like, once you cut the check, you can't do any more homework. You're in the deal. So is this somebody that you feel comfortable giving money to and trust that they're going to have your best interests at heart?
It's very difficult to quantify trust. I mean, we were just joking about, can you trust someone? Can you not trust someone? It's very, very difficult to quantify and answer that. I think a lot of it is based on a few things. So how much money is the sponsor putting in the deal? And then having so there's competence. Let's just clarify, there's competence in what they're doing. That's one form of trust. But then there's also like fiduciary responsibility trust, right? Is this person going to really do what's in my best interest as an investor? And I'd encourage anyone who's looking to invest in a deal, specifically if it's a large chunk of money, sit down, have a coffee, go to lunch, have a meeting, and get to know this person. If you have a common interest, you guys both like to play tennis or volleyball, whatever it is, try to get to really know the sponsor on a personal level. See how they interact with other people, ask for references.
I was about to say cross-reference for sure.
Totally. Like, definitely dig in. Whenever people ask us for references or they want to get to sit down with us and get to know us, we're so thrilled, because we want it to be it has to be a two-way street, right? If you're going to build a relationship, it needs to be a two-way street. Everyone has to feel comfortable with the arrangement and with the relationship, and that's so crucial to get to know the people that you're working with.
So let's talk about the deal that we're buying now.
Sure.
You or me?
Go for it.
Okay. So we're closing on 10 units in Mar Vista. Mar Vista is just east of Venice. So it's still on the west side of Los Angeles, proximity to the beach. You get the ocean breeze, which we've been getting right now. And the renters are people that want to live on the west side, but can't afford Venice, right? Venice is pretty expensive. We just rented out 3 beds for, over $5,000. But then if you go to Mar Vista, they're going to be between $4,000 and $4,500 a month. So there's maybe like a 20% rent decrease just based on the micro location. So we love the area. There's a Whole Foods close by. There's an Air One close by. You're right down the street from Santa Monica, Venice. And then on top of that, it's a huge lot, which everybody knows land is irreplaceable in LA. There's nowhere that you can really build anymore unless you knock down. And if you're going to knock down, you want to have the size of the lot. So we love the land size, the land value, and we love our cost basis, which I'll let you talk about because it's kind of an interesting story about, the price that we're getting it at.
Yeah, so the property's been on the market for about a year. It was listed previously by the seller's property management company at a really high number. Probably it was 5.6 or 5.68 something. 5.689 I think was the exact number, and it was probably worth at the time somewhere around 5.25 when interest rates were at 4%.
I think even like at that point,
3.5.
Yeah.
So they were listed at 5.68. It was definitely overshooting the market. It was probably worth around 5.25, 5.35, something like that. And they weren't able to sell it because again it was just priced a bit too high. And after about 6 months or so being on the market, the seller relisted with another real estate agency. And this time the seller said, I want to sell the property. That's my objective. We had been at the table for 6 or 9 months at the time. And the seller knew that we were real. We had seen the property. We had seen the due diligence, and that we, like we've been talking about, have a track record of buying apartments in LA. So when it came time for the seller to pick a buyer to run with, she chose us, and we were able to secure the property at $4.2 million, which puts us just under 12 times gross, just shy of a 6% cap rate. Once we fill the vacancies, I think it's $440 a foot. $420,000 per unit, and on land, we're at
like 200 a foot.
Yeah, 200 or 240
we're half
a foot.
an acre.
Yeah, we've got 20,000 square feet of land. So cost basis is terrific. Going in yield once we renovate the vacancies is terrific, and like you said, the location is amazing. I think one thing about the location is that it may not just be people who can't afford to live in Venice. It's also like if you have a couple and one person's working downtown and the other person's in Santa Monica, you don't want to necessarily be in, you want to be somewhat central. And we have great access to the 10 freeway, the 405. And I think because of that, the centrality of the location is also going to really help us rent these units for top dollar.
And it's a little bit more residential. So you don't get the busyness of Santa Monica and Venice. It's a little bit more quiet. And, we're looking at building out ADUs, which we have done successfully on a couple projects. We're going to have strong day one cash flow. And we see that we're getting market adjusted pricing. So not only does real estate in LA appreciate over time, but if you can also buy in the right part of the cycle, you'll get cycle appreciation. So I think, like we said, when interest rates were at 3.5%, 4%, it was worth 5.2, 5.3. But now that interest rates are, in the fives, we're getting it for about, I would say like a 15 to 20% discount.
We feel really strongly about this deal. If anyone is interested in hearing more about it, feel free to reach out at the Goldfinger Group, at Hueliahu, Max at thegoldfingergroup.com. Thank you for watching, and until next time.
See you next time.